You want to make money. How many times have you heard the saying, if you buy one Bitcoin it could be worth $1 million? Well, that won't happen unless ETH and BTC go to $100,000 each. If you are Three reasons why Ethereum trading volume surpasses Bitcoin's, according to Coinbase CFO. In a recent talk with CNBC Squawk Box host Andrew Sorkin, the chief financial officer of leading U.S.-based crypto exchange Coinbase named three reasons why she believes the Ethereum trading volume has been outpacing that of Bitcoin in the first quarter of 2021. Besides, she reckons that institutional investors on Coinbase will be more active than retail ones. Three reasons for ETH to surpass BTC in trading volume. The CFO of Coinbase, Alesia Haas, believes that the growth of Ethereum trading volume versus that of Bitcoin comes down to three reasons. The growth of the non-fungible token industry on Ethereum, the increasing volume of ETH locked in the Ethereum 2.0 deposit contract, and the gradual transition of the network to the proof-of-stake consensus algorithm from the proof-of-work one. First quarter for us where #Ethereum surpassed #Bitcoin trading, says $coin CFO Alesia Haas. That was really grown this quarter by the growth of #NFTs. Also, we saw ETH2 staking and the network is transitioning now to a proof-of-stake from a proof-of-work network. Coinbase likely to shift to more institutional money in the future. When asked whether Coinbase is going to see more inflows of institutional money or cash from retail investors, she said that it is likely to be institutional ones. As per Haas, Coinbase is building deep roots at the moment with their institutional clients, which include Elon Musk's Tesla and SpaceX, looking for custody services and continuing to invest in crypto. The CFO stated that institutions appreciate that Coinbase has taken care of security with large investments and the fact that Coinbase has never suffered a hacker attack and never lost any of its investors' crypto since the exchange began operating. After institutions receive crypto custody services, they go into trading on Coinbase, buying data services and then moving into the borrow-lend crypto products that Coinbase has been deploying. Hacker behind $611 million crypto heist left trail of digital fingerprints, according to blockchain security firm Slowmist Crypto New Media. Blockchain security firm Slowmist says the attacker behind a $611 million hack of Poly Network left a trail of digital fingerprints revealing the details of the massive crypto heist. Poly Network, a project that enables the swapping of tokens across different blockchains, tells its 16,400 Twitter followers that its system was breached on Tuesday. Through on-chain and off-chain tracking, Slowmist says that they have identified the attacker's mailbox, IP address and device fingerprints. The blockchain security company also highlights that the attacker initially used Monero, which were later exchanged for Binance Coin, Ethereum and Polygon. According to Slowmist, the three crypto assets were used to fund the hack. Slowmist adds that the attacker appears to have been preparing for the attack for quite some time based on the use of multiple fingerprint information and the movement of funds. Looking at the Poly Network attack, security researcher and Ethereum developer Mudit Gupta notes the event does not appear to be a typical decentralized finance hack. This was not a DEFI or smart contract hack but a traditional key compromise combined with irresponsible design decisions taken by Poly Network. It seems like they used a single keeper. That keeper had control over all of the funds. The hacker probably got hold of that keeper's key via traditional hacks. The hacker used the keeper's key to sign instructions that ordered the smart contract to transfer all funds to the hacker. The smart contract verified the signature, and since only one signature was required, it processed the request. In a letter addressed to the hacker, Poly Network urges the cybercriminal to return the stolen funds. This buy indicator shows the Bitcoin price is ready to explode. Hash ribbons. The hash ribbons indicator created by Charles Edwards uses the 30 and 60-day moving averages of Bitcoin hash rate to determine when minor capitulation has occurred, and uses this to estimate local Bitcoin bottoms. Below is the history of the Bitcoin price and every time that the hash ribbons indicator has flashed. Minor capitulation. Hash ribbons serve as such an effective and historically accurate buy indicator for Bitcoin because it uses the changes in Bitcoin hash rate to measure minor capitulation in the Bitcoin market. During periods where mining operations are turning off their rigs, it shows that it is uneconomical to mine. Hash rate declines, blocks are mined slower than the 10-minute block target, and eventually difficulty will adjust downwards to encourage these miners to plug back in. This is typically the process in which miners turn off their machines in large numbers, which is subsequently followed by the hash ribbon indicator signaling capitulation, followed by an eventual buy signal. However, the cause for the massive decrease in hash rate wasn't entirely caused by increased competitiveness in the mining industry driving profits down, but rather because of political decree in what ended up being the largest nation-state attack on Bitcoin ever, from the arms of the Chinese Communist Party. Over the course of 6 weeks, the Bitcoin mean hash rate declined by 53%, and although the capitulation event was more artificial, the decline in hash rate still had a very meaningful impact on miner revenues for those who still remained plugged in. As seen in the July monthly report, daily revenue for Bitcoin miners declined from a high of $67.5 million per day in May to a low of $19.8 million per day in early July. Not only were the remaining miners squeezed while difficulty was lagging in the midst of 4 straight downwards adjustments, but mining operations in China, who were abruptly faced with moving their entire operations out of the country, most definitely had to liquidate reserves, of which a majority can be assumed to have been stored in Bitcoin, as is the case with all miners, who aim to hodl as much Bitcoin as possible.